Welcome to Real Estate Talk, where we tackle your questions about real estate. Courtney, today's question is, how does mortgage interest work?
hmm
Maybe before we go to mortgage interest, we should ask the question, what is a mortgage?
Yes, yes. Let's start there at the foundation. A mortgage is a loan that one takes out in order to buy a home or any other type of real estate. And a big part of a mortgage is the interest that the lender charges. That's what the borrower is charged to be able to borrow the money. That's mortgage
Okay,
interest at its foundational basic level.
I knew this was going to happen, but I think we have to do some math. Okay, so you
Okay,
have a
yeah.
mortgage of, say, $400,000
Mhm.
and a fixed interest rate of 5%. That means that you would pay $20,000 in interest that first year. Is that right?
Yep, that
Okay,
is.
great.
And let's not forget that when you take out a mortgage to purchase a home, the bulk of your payment for the first, I don't know how many years, 2 or 3 years, maybe 5 years, goes to interest.
Yeah, and that's amortization, right? Where
Yes.
it basically means it's a little bit more heavy in interest for those first years of payments.
Yeah.
And over time, the more you start going to be chopping into that principal balance of the actual loan itself.
Absolutely.
So the total interest rate depends on a lot of different factors. Of course, like the amount of the loan term, the interest rate type. You've heard probably about adjustable rate mortgages or fixed rate, which is basically adjustable, can go up and down depending on where the bank is setting interest rates. And within the terms of that agreement, fixed is what it sounds like. If you took out a fixed 30-year loan at 5% in 2030, at 2060, when that mortgage is up, you're still at the 5% rate. So it's
Yes.
fixed that way. And especially like the actual interest rate itself is what impacts the total interest rate that you're going to pay.
Yeah. So, Joe, let me ask you this. How do lenders set these rates?
Yeah, it's a lot of different things, but some of it's macro conditions. And what I mean by that is right now, the big I word that's been going on it's for some time is inflation. That has a lot to do with what interest rates are doing.
Mhm.
US economic growth certainly is a contributor to that. Housing market conditions. So if it was a buyer's market or a seller's market, and depending which way things are going, what the balance is there, that impacts interest rates, and even things like employment rates and the level of employment in the country as well. So lots of different factors, and usually that's what the output is where a bank sets the rates.
And those are factors that we absolutely have no control over. So
Unfortunately, yeah.
yeah, I want to talk a little bit about the things that we can control a little bit more that a bank is looking at when they're evaluating what to approve a buyer for. So
Yeah, that's a
obviously,
great way to think about it. It's like, what can I do? Like, it's great that inflation is what it is. It's terrible that inflation is what it is.
yeah,
Market conditions. What can I do as the borrower to
yeah.
impact the interest rate?
Credit score. I mean, that's what most people's minds goes to. Obviously, the different loan types come with different, kind of ranges of interest rates, whether it's an FHA loan or a VA loan or a conventional loan. Your down payment. So, saving money to put a substantial down payment on your home is actually going to help you get a better loan term, I should say. Debt to income ratios and work history is also a few things that a bank is going to look at. And last but not least, and I say this because this came up this week actually in helping one of our clients out, is there's other household variables that are considered. So, for example, my situation this week is our client had an adult son that lived with her that paid the rent. So that actually could be something that a lender sees as a positive. Obviously, they'd have to have a paper trail of all of that. But those are some other household variables that a lender is actually going to take into consideration.
Yeah, that's really interesting too. And I just made me think a little bit about another point where uh, the mortgage can be paid down or you can get a lower rate. I know we're talking about mortgage interest, but for the mortgage itself,
Yeah.
we're seeing it more in negotiations too, where if a seller is offering a concession to a buyer, you can use that money in some cases, talk to your lender
Yeah.
to pay that rate down
Yeah.
rather than what's advertised up front too. So we see that pretty often as
A-
well.
absolutely. And so, Joe, just to kind of put it into context, let's say they're buying their rate down, or maybe that's an incentive that a builder is offering, and they're going to buy it down by 0.5%. Does that sound like a big number to you?
It doesn't on its surface, but I know better. I know, like, that's the reason we talk about interest rates so much, is because that half percent on a $300,000 mortgage means that you could save over $30,000 in interest payments over those 30 years.
Hmm.
So small percentages in this case make a really big difference in the interest that you're going to pay over time, which is why interest rates have been the story of the US market, that and low inventory over the
Hmm.
last 5, 10 years.
Hmm.
So little percentages, big difference in payments.
Absolutely. And I want to give the folks watching just this quick little tip. If, let's say, you have a mortgage and you're like, I really want to pay this down quickly, talk to your lender, okay? Talk to your CPA. But a quick little trick is, if you make one extra mortgage payment per year, that it could substantially cut down not only on interest, but on the life of the loan. So if you're trying to pay your home off quickly, that might be a neat little strategy.
Yeah, that's a great tip.
Yeah.
And sometimes when existing homeowners see interest rates come down from
Hmm.
where they had purchased, this hasn't happened a lot lately because it's been going the other way.
Yeah.
But there are situations where you could refinance to get to, from a 30 to a 15-year loan, not spend as much paying off that loan, which would, of course, in some cases, lower the interest as well.
Yeah, at the end of the day, this is huge because, mortgages matter. It's important that you consult with the lender, you shop around for different rates and different loan products, but most importantly, making sure that you have the right agent on your side to help you navigate this buying scenario, these conversations. Like, that's what we are here as real estate professionals. We'll drop some more information that you might want to consider in the description below. We love to hear from you. So comment below if you have any additional real estate questions so we can feature it on another episode of Real Talk. Thanks again for tuning in. Be sure to like and subscribe to our channel, and we will be talking to you very soon. Thanks so much.